The Nasdaq is close to record highs. US tech stocks have been booming, and a wave of AI investment is holding together what otherwise is quite a fragile and uneven American economy. Whilst ordinary households struggle with the cost of living and falling job opportunities, tech giants are spending at levels last seen in the dot-com bubble. This optimism is fueled by the belief that artificial intelligence will unleash extraordinary gains in productivity, efficiency and profits. Now, spending on AI data centers alone is expected to reach $390 billion in 2025. Yet, the total revenue from generative AI so far is only around $60 billion a year. Now, Morgan Stanley predict that this figure could soar to over $1 trillion within just a few years. And if that actually happens, it might justify today's huge levels of investment and record valuations. But what if those expectations are built on sand? The Bank of England has already warned about the risk of a sharp market correction. Jamie Dimon at JP Morgan says that many assets now look like they're entering into bubble territory. And there are already warning signs in the real economy. Large firms have seen a decline in AI adoption rates this year. And last week, when OpenAI hinted that the government might need to support their investment in AI infrastructure, investors were briefly spooked. It's exactly the kind of small event that can start to puncture a bubble. And if a bubble bursts, the consequences could be severe. A former IMF chief economist recently warned that a market correction on the scale of an early 2000s dot-com crash could wipe out $20 trillion in wealth, roughly 70% of US GDP. And this time the stakes are much higher. The stock market is now larger as a share of the economy than ever before. More Americans are exposed to equities through pensions, mutual funds, and also mobile trading apps, which have become increasingly popular, especially amongst young people. So consumer confidence is far more tied to market swings. And a crash of the size of a dot-com crash could cause consumption to fall by more than 3% and shave roughly 2 percentage points off GDP, definitely enough to push the US economy into a deep recession. And that's, of course, before all the secondary effects on reducing investment, bank lending and credit markets. Because the US economy today has increasingly become two-speed. On the one side, you've got a booming tech sector, and on the other side, households under pressure. And without all the tech investment that we're seeing, US economic growth this year would be closer to 1%. Analysts estimate that AI and technology may account for almost half of all America's growth in 2025. And it's like the whole economy has been balanced on this one rather narrow, perhaps unstable plank. And the fallout from any big crash wouldn't stop at America's borders, because foreign investors could face losses exceeding $15 trillion, around 1/5 of the rest of the world's GDP. The US stock market now makes up nearly 60% of all global equity value, despite the US economy declining in size of global GDP. And it shows just how dependent the world and stock markets have become on US tech. Also, there's another problem that global economic growth has been declining for decades. Average growth rates are going down, and one of the few success stories in recent years has been productivity growth in the US, driven a large part by tech growth. It means that global growth is unbalanced and ironically reliant on the US to some extent. But with all the tariff wars and uncertainties created this year, a crash would have a powerful ripple effect. Now, last week, shares and tech stocks slumped to one of their worst weeks in months. And the more speculative an asset was, the bigger the drop. Palantir, one of the most expensive stocks in the world, fell 8%. The big 7 tech stocks fell over 2%. Also, some of those small penny stocks, beloved of small retail investors, fell heavily. And one of the big changes in the stock market in recent years is this growth in small-time, young, often investors. They often have actually relatively low income. And JP Morgan found that despite constantly low savings rates in the US economy, around 4 or 5%, retail investment in shares has increased 300% since 2015. Young, low-income people are attracted to buying shares for a few reasons. Firstly, with house prices out of reach, dabbling in stocks is seen as a way to try to increase wealth. Perhaps if you get lucky, you might be able to buy a house. Secondly, the growth of all these mobile trading apps has made it really easy, almost addictive, to play the game. And the concern is that these new traders have poor financial education and limited savings. But what it means is that a stock market crash could really create a negative wealth effect, reduce spending in the economy, and leave many people really nursing very heavy losses. An additional problem is that margin debt is at a record high. This is the amount that investors have borrowed from their brokers to purchase more stock. FINRA report in September 2025, this reached a record 1.1 trillion. So it means that any fall in shares would lead to big losses, with knock-on effects to the banking system. And that could lead to a lower lending, a fall in the money supply, decline in capital investment. And of course, don't forget the impact on confidence. As shares fell last week, it also had a knock-on effect of crypto values, with any concern about the state of the stock market usually adversely affecting crypto. For something which is sold as been something quite secure, crypto actually has a strong correlation to stock values. So we could easily end up with a double crash, a fall in shares causing a fall in the speculative value of crypto. Now, having said all that, not everybody is convinced that there's going to be a massive crash. Firstly, it is worth pointing out the big 7 tech firms are actually incredibly profitable, with big profit margins, and that is funding a lot of the capital investment. It's not like they're borrowing heavily to fund the investment. Secondly, AI adoption, you could argue, is still at its early stages and can continue to increase. It has the potential to significantly reduce costs and increase revenue for firms, which would mean a lot of investment would be justified. And although people do point to the high valuations of the stock market today, for example, the Case-Shiller index is near a record level, it is worth bearing in mind that tech stocks, ironically, do not have the same level of overvaluation as in the late 90s, early 2000s. Back then, Cisco was 101 times earnings, Microsoft 69 times. Today, Nvidia, Microsoft, and Apple are all trading at around 31 times earnings. It is high, but given the potential growth, not ridiculous bubble territory. And don't forget, even if there is a stock market crash, it doesn't necessarily crash the economy. The 1987 stock crash barely registered in terms of economic impact. The dot-com crash caused a blip in GDP, but nothing major. The real crashes which did devastate the economy was, of course, the famous 1929 example, precursor to Great Depression, and also in living memory, the credit crunch of 2008. But here it was much more than share prices falling, but also the much bigger issue of banks losing all that money from mortgage defaults. And although the US housing market is broken, mortgage defaults are nothing like in 2008 because the new 30-year fixed mortgages have effectively avoided the problem of 2008. Also, if there was a stock market crash and negative wealth effect, you would of course expect the Federal Reserve to significantly cut interest rates, possibly even quantitative easing, which will help to promote economic growth, reduce the impact of the recession, and make shares relatively more attractive compared to bonds and gilts. Don't forget, US interest rates are quite high. There is room for them to go down. So there are definitely reasons to be concerned about the state of the US economy. It has become heavily tilted towards big tech. And also the economy is much more exposed to the stock market than ever before because of the growth in small-scale investment by relatively low-income groups. Now, although AI and crypto are entering bubble territory to different degrees, at least with AI, there is some real-world application. But whether they can get business to pay what they hope is another matter. This video goes into more detail about whether AI is a bubble or whether it offers real gains. Anyway, thanks for watching. Interesting times. Do subscribe. Let me know what you think in the comments.